Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's look ahead to the forthcoming Eurozone inflation reading coming out on Friday, the 1st of March. A new month hoping to kick off with a bang, and certainly markets are expecting to see some disinflation coming into play once again. Is that going to spur further upside for equity markets? Is it going to spur weakness for the euro? Certainly, these are some of the topics we'll be digging into in this week's show. Certainly, if we're looking at market expectations, we are looking for downside in terms of that inflation rate, 2.5% expected from 2.8%. Bear in mind, this is coming off the back of a predicted switch from minus 0.4 last time around on a monthly basis up to 0.5%. So almost evening things out after a significant decline last time around. Fortunately, we're also expecting to see a significant downside move in terms of the core inflation rate, 2.8% from 3.3. So if markets are to be believed, if market expectations are to be believed, then we're likely to see things really start to gather momentum as we see that push back towards target in the Eurozone. A few different things I wanted to show you here. First and foremost, this is the outlook for a number of different members within the Eurozone. Let me just get my head out the way a little bit there. Actually, better off without it at all. There we go. So what we can see here is significant disinflation for the likes of Italy, well below target, but starting to sort of turn up a little bit. Spain also starting to struggle to drive inflation lower. But we have been seeing further downside for the likes of France and Germany. It's helping things move towards the downside from a sort of wider perspective. This image that I got from Eurostat, I think is an interesting one, just because it shows you the sort of breadth of experiences within the region, and the fact that we're not talking about a single country. They have to determine monetary policy for an entire group of countries. That can be relatively difficult, but certainly it's moving in the right direction. And most notably, we've really seen that disinflation pick up for Germany in particular, pushing them towards a more dovish stance at the Bundesbank. And that really, given the strength and the prominence of the Bundesbank, is likely to have an impact on sentiment at the ECB. In terms of some of these charts, get my head back in there now. Here, first and foremost, is the Eurozone headline inflation reading. A few different segments for me to take you through, but if you follow my shows regularly, you might understand where we stand now. First and foremost, the top level, 277, that's where we stand on the headline reading. In terms of the recent trajectory of inflation, you can see that the last 9 months, which is why I've got 9-month annualized on the bottom, the last 9 months, we've been seeing really significant sort of disinflation. No real major, significantly strong monthly readings. And in actual fact, those strong readings really are coming in the form of the next 3 months. This time around, we're seeing the February 2023 figure drop out at 0.8. And as you can see, next time around, it's actually higher than that. So the disinflation is really likely to ramp up this month and next month, and to a degree, the month after that. But if you look at the 9-month annualized, you'll notice that essentially we're at 0.55. So that means if you look at the trajectory we've been traveling on the last 9 months, we're well below that 2% target. It's interesting that we've kicked off this new week with comments from Christine Lagarde, the president of the ECB, who continues to tout the line of, we need to see further evidence of disinflation before we want to cut interest rates. Well, you're going to see it. And, you know, we're talking about this time around, if I just take you back to market expectations, markets expecting a 0.5% reading. That's out of whack compared to where we have been recently. So if we see a number anywhere near the numbers that we've been seeing over recent months, we could really see that disinflation pick up to an even greater degree to drive that headline number much closer towards target, and really highlight the fact that in another month or so, we're very likely to find ourselves below that 2% target. In terms of the core reading, it's not necessarily too dissimilar. Now we're at 3.3 or 3.26 at the moment. We can see that the February 2023 figure of 0.84 is stripped out, or is going to be stripped out. So once again, very strong chance of disinflation this time around. And again, if I just take us back to the first slide, you can see that we're expecting 0.5% to be taken out. right? So that really highlights the fact that we're seeing this really big number falling out of the year-on-year metric, and those base effects are really going to benefit the trajectory of that annual figure that's at 2.7%. So in terms of, oh, sorry, that's at 3.26% because we're out on that core one here. So we've got a couple of really big readings coming out. So I think we're going to see actually the core reading driven down to a greater degree, because as you can see here, 0.8 this time, but then next month, an even greater figure coming out. It's a pretty chunky number coming out for March. 0.2% is the 9-month annualized figure. So that, the question mark of whether we're going to get back below 2%, the fact that we're seeing Christine Lagarde saying she needs to see more evidence of it, well, it's not going to take long for her to have to come out and say, yes, we're pretty much about to break back below that 2% target soon. And therefore, they're going to have to take a relatively dovish pivot, considering the stance and the tone that they're taking at the moment. That can't last very long, given the trajectory that inflation looks very likely to move within over the coming months. In terms of market expectations, we have for the March meeting, the prediction is that we're going to remain as is. April meeting, 65% chance. And then June, that's when markets are expecting them to move. Now, if we look back at, say, how things stand on the core metric, we can see that in 3 months' time, there's a chance that we're near enough going to be at 0% inflation. So we can see in a month's time from now, so sort of late March, we're going to very likely break back below or hit that 2% target. So I think there's a good chance that we start to see the percentages of that April meeting really ramp up in terms of the potential for a rate cut from the ECB. And this is where this announcement really is a particularly interesting one at the moment. Markets aren't really pricing anything until June. But I think that doesn't make any sense, because ultimately, yes, we're seeing this relatively steadfast approach from the ECB. But from an economic perspective, there's still question marks, particularly around the German economy. And we've got disinflation that essentially puts it on track to drop well below that 2% target before long. And therefore, if they start moving in June, most likely thing is that they're going to be moving after the fact. And ultimately, these actions, as we saw when we saw inflation ramping up, the decision to raise interest rates doesn't immediately hamper that inflation pathway. So the disinflationary pathway doesn't get hampered immediately by cutting interest rates by 25 basis points. You could argue that, well, inflation's been so high for so long that it might benefit them to keep it below 2% for some time. That may be the case, but certainly I think there's a good chance that we do see them sort of having to talk up the idea that we're going to see a return to easing soon enough. And I think that 11th of April meeting is a live one in my mind when it comes to the possibility of a rate cut, much more so than that sort of 35% chance that markets are currently prescribing to it. So if we see a repricing towards an interest rate cut in April rather than June, how would that impact markets? First and foremost, this is the DAX. It has been going higher. Essentially, we've hit 4 consecutive weeks of record highs for the DAX. Now, we're pulling back at the moment from this resistance level 17446. Essentially, we've been consolidating here, but crucially within this consolidation, you can see that we're seeing this sort of stepped move higher. So we are seeing higher lows. So this is actually great. We're looking here at a potential retracement. And so let me just get some of these fibs on here. So, we've hit the 50% retracement at 174.17 so far. We've got 174.06, which is 61.8, and then a 173.93, which is the 76.4 fib. This pullback that we're seeing at the moment to kick off this week, I would see as being relatively fleeting. And certainly the way that I see things playing out in terms of the outlook for the ECB interest rate cuts and the significant disinflation that looks likely to come on Friday, that likely points towards the bulls coming back into play for this market. So if we break back below this area of support between your 173.54, which is the bottom end of this consolidation zone, up to the 173.72, if we start breaking into that area, maybe some question marks are being asked. But until that happens, the near-term pullback to me looks like something the bulls are probably going to jump on board once again. And then I wanted to look at euro dollar. This is an interesting one. Essentially, we saw this uptrend playing out the back end of last year, coming into this year. We seemingly topped out here in 22, 20, coming into 23. We topped out here at the sort of midway part of last year. And then what we've been seeing here is this pullback at the beginning of this year, but starting to regain ground over the past week and a bit. The question mark here is, do we rally into a wider area here before we roll over? Because we've now seen that breakdown through this key support. So I see this as a retracement within a bearish theme. Do we rally into this area here and sell off, or do we maintain the trend that's evident here on the daily time frame, which would mean essentially as long as we don't break this 108.975 mark, then it looks relatively bearish. Well, that still holds for the time being. So that's the key line in the sand here for this week, 108.975. If we remain below that level, I think there's a good chance that we do see this market roll over. The hourly time frame should give us some sort of granularity on that. So essentially, if we break below this 108.027, then it looks like this near-term rally is over and that the bears are going to be coming back in charge. So the key thing here is, do we break 108.27 or do we break 108.975? The first one to happen will likely determine how things look over the near term, but certainly I think there's a good chance that we do come into a more bearish phase here, which should be bearish for the euro if we start to see them bringing forward the expectations for a rate cut, but also come into a potential US dollar weakness story because it's essentially a risk on play for markets. So bearish for euro dollar from a wider perspective, I think there's a good chance that we roll over before we break the 108.975. But if we do break that level, then I would see a deeper rebound as being, again, just a precursor towards the bears coming back into play. And then another one to be looking out for here. This is also a play on potential strength in the energy markets. May happen, may not. I think there's a good chance that they're basing out, but it's taking a bit of time in doing so. I think the interesting part of this is the fact that with EUROCAD, what we've seen here is this sell-off, the consolidation, the sell-off, and now we're rallying once again. So if we break up through the 147.352, then we're looking at an extension of this current rally. But until that happens, there's question marks of whether this is another leg within this step move lower. And we're back into that 76.4 Fibonacci level as things stand. That is at, let's try and get it clear of here, 146.705. That's your 76.4 fib. So I think there's a good chance that we do see this rolling over. But of course, we're talking about Friday, and I'm currently speaking on a Monday. So things can happen in the meanwhile. But yeah, we'd need to break the 147.352 to point towards a stronger move towards the upside. Until then, the bearish trajectory that has been playing out over the past couple of months do look like they could come back into play soon enough for the likes of euro against the Canadian dollar.